Welcome to this explainer. You know, the stock market is something we hear about every single day, right? It's on the evening news, it's screaming at us in financial headlines, it even comes up at the dinner table. But how often do we actually stop and look at the machinery underneath it all? Well, today, we're going to dive right in and demystify exactly how the stock market actually works. We're going to strip away all that intimidating jargon and look at the actual engine driving global wealth.
But before we get into the heavy mechanics, I want you to ask yourself, are you already an investor? You might be sitting there thinking, nope, no way, I've literally never bought a stock in my life. Well, hold on a second. If you have a 401k or a similar retirement plan set up at work, you are very likely already an active investor in the stock market. So you're already in the game. You just need to learn the rules so you can play it with total confidence.
To make this massive topic super approachable, we've broken it down into 5 logical building blocks. First, what is the market? Second, how the market works. Third, understanding market indexes. Fourth, choosing your investment options. And finally, 5 steps to start investing. Let's jump in.
Okay, Section 1. What is the market? Let's build the foundation. People so often picture Wall Street as this giant, chaotic casino. But at its absolute core, it's an economic engine. Companies sell shares of ownership to raise capital, and investors buy those shares to share in the profits. The really crucial point here is that it's not a roulette wheel. It's a practical way for businesses to fund their growth, like, building new factories or inventing new products, and for you to directly participate in their success. And this mutually beneficial setup absolutely isn't some new trend. This concept goes way back to the year 1602 with the Amsterdam Stock Exchange, which is when the Dutch East India Company became the first public company. Fast forward a bit to 1790 and 1792, and we see the Philly Exchange and the famous Buttonwood Agreement, which basically birthed the New York Stock Exchange. Then the London Stock Exchange pops up in 1801, so this system has evolved over centuries, growing from literal coffee shop meetings into a massive, instantaneous global digital network. Moving right along to Section 2, how the market works. The actual mechanics of trading.
To understand how trading actually functions, we have to compare the primary market to the secondary market. When a private company decides to go public, they issue brand new shares in an initial public offering, or IPO. When you buy into an IPO, you're on the primary market, and that is exactly when the company raises its capital. But if you buy or sell those shares later on, that's the secondary market. Here's a real mind-bender for a lot of beginners. The company itself doesn't make a single profit from those secondary trades. You are simply trading with other everyday investors on exchanges like the NYSE or the Nasdaq.
So how do all those secondary trades actually happen? Well, every single transaction needs a buyer and a seller, and they are separated by what's called the bid spread. The bid is simply the amount a buyer is willing to pay, and the ask is what the seller is willing to accept. Almost always, the seller wants a little more than the buyer wants to pay, which creates this gap. For a trade to actually execute, someone has to compromise to close the spread. The whole market is essentially millions of these tiny little compromises happening every single second. Now, all of those millions of trades are heavily influenced by the real world, macroeconomic factors. Take March 2020, for example. The market fell sharply due to sheer pandemic panic. Uncertainty absolutely crushed investor sentiment, causing massive single-day drops. But, and here is the kicker, major indexes hit record highs less than 6 months later. This brilliantly illustrates why long-term investing almost always prevails over short-term panic. A slow, steady approach means you can weather that crazy volatility.
All right, Section 3, understanding market indexes. How we're measuring the market.
Whenever the news says, the market is up today, they're usually talking about a specific market index. And the rock star of those indexes is the S&P 500. 80%! That is a massive number. What's so fascinating about the S&P 500 is that it tracks just 500 large U.S. companies, but those 500 make up roughly 80% of the market's total value. Out of thousands and thousands of companies being traded, just 500 represent the vast majority of the wealth. That's exactly why it's seen as the absolute best indicator of overall market health. Now, alongside the S&P 500, we have a couple of other major benchmarks. The Dow Jones Industrial Average tracks just 30 U.S. blue-chip companies, and it explicitly excludes transportation and utilities. Then you've got the Nasdaq Composite, which tracks thousands of stocks, but heavily leans into technology. Because these indexes are weighted by market capitalization, which basically means the bigger the company, the bigger its share of the index, they overlap to give us a remarkably clear, reliable snapshot of the overall economy.
Let's move to Section 4, choosing your investment options and building a portfolio.
It's time to translate the jargon so you can figure out what to actually put into your own portfolio. If you decide to buy shares in an individual company, you'll generally pick between two options: common stock and preferred stock. Common stock is what most everyday people buy. It gives you voting rights at shareholder meetings and the potential to earn dividends when the company shares its profits. Preferred stock, on the other hand, strips away your voting rights, but in exchange, you get VIP priority for dividend payments. It's a really simple trade-off. Do you want to vote or do you want priority payouts?
But what if you don't want the stress of picking individual stocks? If you'd rather buy a diversified basket of stocks all at once, you'll likely look at funds. Your choice there basically comes down to how and when they trade. Exchange-traded funds, or ETFs, trade continuously throughout the day on stock exchanges, exactly like individual stocks. You can buy them at 10 a.m., sell at 2 p.m., whatever. Mutual funds, however, are bought directly from the fund companies, and sales close only once at the very end of the trading day. Honestly, both are absolutely excellent tools for diversifying your portfolio.
And finally, Section 5, Steps to Start Investing, your actionable playbook.
Setting up an account today is incredibly, ridiculously streamlined. First, just choose your account type, like a standard taxable account or an IRA if you're saving for retirement. Second, pick a brokerage firm by comparing their features and fees. Third, open and fund your account. Fourth, do a little research and choose your investments. And fifth, place your first buy order. The absolute beauty of this is that you don't need to call a guy in a suit on a chaotic trading floor anymore. You can knock out these 5 simple steps online right now in your pajamas.
As you take those first steps, keep these core principles in the back of your mind. Set specific investing goals, because saving for a house is a very different game than saving for retirement. Understand your personal risk tolerance. Always diversify your portfolio so all your eggs aren't just sitting in one basket. Don't be afraid to ask for help from a professional if you need it. And crucially, monitor your account. But please, don't obsess over it. Checking your app every 5 minutes will just drive you crazy. Staying calm during the market's natural volatility is the real secret to long-term success. Which brings us to a really crucial question for you to consider today. Knowing that the market isn't a casino, but rather a system of shared growth, how are you going to put your money to work? You possess the blueprint to navigate Wall Street now. You understand the history, the mechanics, the indexes, and the practical steps to actually get going. The market is no longer this big, scary mystery. It's a totally accessible tool. So, the ball is in your court. It is entirely up to you to decide how you will shape your financial future. Thank you so much for joining me for this explainer, and happy investing.